Hi everyone, this is Michael Bengia with Lifetime Investor, and this is the Market Trend Advisory Weekend Review video for February 25th, 2023. Okay, so let's go ahead and get started. So this week we had a deterioration in the overall market trend and also with individual stocks. So the overall market trend went from a confirmed uptrend to uptrend uncertain or uptrend under pressure. That's why we have now our yellow stoplights. And we did see, and the NASDAQ has been holding up a little bit better than the S&P, but we did see that we had some sell signals that came out. Now, this knocked us down from 7 out of 7 to 5 out of 7, but because the power trend is on, we're still at 100% exposure. So that's what the whole point of the power trend is, that you can have some sell signals, at least in a strong uptrend, and it doesn't start knocking you out, so you're actually selling and then you have to buy it back. So it gives you that little buffer. Now, so that's been holding up. Whether or not this is going to continue down, we have to see. But that's kept us at 100% exposure. On the S&P, though, the power trend went under pressure because we broke under the 50-day. And so that knocked down, you can see here, now the market count only goes up to 5, which is the normal. And then we had a sell signal, so that took us down to 4 out of 5 at 90%. So NASDAQ, we're at 100 still. This, we're at 90%. We're also starting to get a little more institutional selling days. We're at 4 here on the S&P and 3 on the NASDAQ. So you can see the institutions are starting to sort of pick up their selling, which is not a good sign. And then sort of called the canary in the coal mine, is how individual stocks and non-index ETFs are acting. And with this, we went down to just 15% of exposure. We have the little red lights there. And, you know, individual stocks, and we're also talking about the leading stocks, stocks that are at or near new highs or all-time highs, breaking out of bases. And so that doesn't include a lot of what's still being kind of bought again, all the beaten down former tech leaders, which some of them were down, 50, 60, 70, 80, 90%. And that money's still pouring back into that. So that's not the ones that we're looking at. But one of the things that has been really powerful about this indicator alone, even if you're just trading the indexes, is that it has been really showing us what's going on under the surface. Because at times what the indexes are doing and what stocks are doing can completely diverge, and we've seen this for almost 2 years now. We saw it in 2021 when the indexes were still holding up or even going up, and most stocks were starting to fall off. You saw that in our the percentage of stocks above the 200-day, and then we actually started tracking it for a while there for both the NASDAQ and that, and it just went down into under 20%, and the indexes were still holding up. So that just didn't work. Eventually, the indexes threw in the towel too, and then but we've never seen, even in this big rally we've had in 2023, we haven't seen individual stocks working. We've never gotten, I think. We maybe got up to 35%, and we were pretty quickly came back down. Really, in just a few years, this has just never been green. We've never seen the ability to go up because they're just not working. We've never been at 50% or higher. So it's really telling you that the market is not all that healthy under the surface. So really, this is a real powerful indicator. Make sure you kind of use it, even if you're not trading individual stocks, but it's been giving us that warning. Even though the market early in this year in January was like, oh, this is just going nuts, but we're not getting the confirmation from this leading stock indicator. So that's something you want to kind of keep in mind. I think I covered everything else here. Yeah, the selling days have been picking up. If they start picking up much more from here, we'll start getting a lot more sell signals. This system does have a big component of distribution or these ISDs. And so very quickly, this can start taking us down to, if this goes much higher, our market count can very quickly go down to, low numbers or 0, which would be back to no exposure. Okay. In terms of our investing strategies, our numbers have been coming back down again, just because the indexes have been starting to pull back a bit. But overall, so far the buy and hold has been beating our numbers a little bit. mostly because the market just kind of blasted off while we were still not 100% invested. And so that happens. I mean, at times, no system's 100%. You're not always going to beat it, but over time, we definitely beat the indexes with a lot less, the buy and hold indexes with a lot less volatility. And so, right now we're just kind of holding in there on the NASDAQ, and we're a little, lagging a little bit on the SPY. So let's take a look now at the charts. So you can see here the Dow, which was really the leader coming off the bottom in October. We had a really strong rally, kind of broke above these highs over here in August. And then since then, really, it looked like it was forming almost like a nice cup with handle. And then within that cup with handle, we had another little cup with, well, it's kind of hard, yeah, little cup. You can see it kind of come down here and then handle. When you see this, especially with stocks, that really it's a really powerful bullish sign that we're going to be going out the top. But we didn't. We kind of just broke down below the 50-day. That's this line here. The 21-day is about to cross it. And it looks like we probably will be testing the 200-day on this. I'd be surprised if we didn't, because now we're below. So really this has done the opposite, and really this chart is sort of portending more weakness. Let's take a look at the S&P. Now this one is actually, it broke below the 50-day, but it got support right at the 200-day. Now, if this is going to hold, well, we don't know. I personally don't think it's going to. I don't think the actual bottom is in yet, but that's my own personal opinion. Anything can happen. Even if this is the bottom right here, let's say this is you could call this the low, but we may not have bottomed out yet, which means that we may have this may hold, but we may have a lot of back-ending filling and just volatility that goes on, and while this is still holding. So it doesn't mean that we have easy, times which we're seeing. We're not seeing that in the market yet. But anything can happen, and we'll cover a couple things in a minute in terms of interest rates and what's going on. But yeah, it did get support at the 200. Now 200 is starting to level out a little bit, but we're still in a downtrend. You can see it's still heading down. The 50 is starting to turn around a little bit too. So that's a little bit of a warning there. So let's go to the NASDAQ. Now the NASDAQ, we actually opened up below the 200, which is still declining, and we came up and we closed right below it. And you can see here, this is really still a really strong downtrend. The 50 is not even above the 200 yet, and it's starting to come up. They may cross, we don't know. But you can see here, this high here wasn't anywhere near the August high. If I go back to the S&P, we didn't even get to the August high either, though we did get above the December high. This one, yeah, we got above the December high too. But you can see going back to the Dow, much stronger, but it's starting to fall off. So we'll see what happens. This is kind of a crucial spot where we are. Volume hasn't been super high or anything too, so we're just kind of curious. We're kind of heading down with not a lot of selling, even though we're getting some institutional selling days. And then finally, the Russell. The Russell's holding up a little better, which is why we're starting to see more small cap stocks appear on our lists. But still, it's starting to come off, but we're still above the 50-day, still above the 200. So we'll see what happens. This didn't quite get above its August high, but got close. It looked like really powerful, but starting to pull back here. Okay, let's look at the technicals, which have broken down a little bit, but not too bad. The percentage of stocks with the 200, we were in the upper 60s. We've come down to the low 50s. Lows again, 52-week lows are outpacing 52-week highs again. We saw that for a long, long time. You can even see here just the red starting to appear, lesser green over here. This is just percentage of NASDAQ, the NASDAQ percentage above the 50-day and 200. We've gone a little negative on the 200 again. This is starting to come down. This is sort of the leading growth stocks that have broken out and haven't failed. This has really just dropped from this 72 upper 60s down to 21. And then down volume starting to outpace up volume again. So We don't know if this is the beginning of a bigger down move, but really it's not what we really want to see if you're a bull. In terms of the VIX, I do want to show the VIX is again back to this solid red again, and I do want to show this. This has been a very powerful chart. I update it every week, and it looks like we're getting the same thing. So what this is telling us is that whenever the VIX has come down to 16 to 18, that's kind of been the high of the market. Here, this is the S&P up here in this black line. So you can see here we got down to 16. This is in December of 2021. That was the beginning of the bear market. So we got down to this VIX, and that was the high in the market. Here we got down to the 18 in 1845. That was the peak of that move. And then we came up here. We got down to 19. And then recently we got down to 1706. And you can see we're starting to roll again over on the S&P. So now we don't know if this is going to be the same thing, another leg down. It looks like it. Sorry, I didn't update this. The current VIX is, 2167. Sorry, I'm just going to pop that in here. 2167. Might as well get it correct. Okay, so let's go back over here to the sentiment. We have just seen a little bit drop, but not much, which is, some people think this is good. You can look at it both ways. There's still a lot of bullishness going on. This was pretty extreme. That's their official descriptions. This is not mine, but we're starting to come off that extreme greed. But we're still pretty bullish overall, and the VIX is still not super high. We're starting to see the tops. Where you see up here, we got to the 30s is where generally the market starts to bottom out. We're nowhere near that. But what we want to see with the VIX, and this has been something I've talked about a lot, this has just been solid red for just month after month after month. Normally, in a market that's really a strong uptrend, you'll see the VIX drop down to between 17 down to 10 is really low, but anyway between 12 and 17, that's sort of the sweet spot. It means that the volatility has calmed down. And if you look at a longer chart, I don't have one here. Maybe I'll bring it up next week. That's when you see the really nice up moves go on, when the volatility is low and there really isn't a lot of geopolitical events going on or interest rate things and issues with the Fed, all the stuff that we're seeing now. It's just really more smooth sailing. And that's when you get really the nice moves in stocks and the indexes, all that volatility. And so we're just not seeing that. We're starting to go the other way again. So another little warning sign there. Okay, so just we've had this slide up in various forums for a long time. Overall, we're just still in that dangerous make or break point in time. In terms of the charts, you can see that the NASDAQ is we're just at the 200-day. The S&P is below the 50 and just hit its support at the 200. If the market goes below the 200 much more, we're probably going to just continue to see lower prices. So just to kind of recap, we've been getting a lot of inflation data this week and last week, and it's starting to show, which is what the market had not been pricing in, is that we're getting acceleration in inflation. We saw that with the PCE this week. We're just not getting those signs. The market was already pricing in that there was going to be, basically no recession. It was the Goldilocks scenario. The Fed was going to be cutting rates. I don't know where they got that from, because the Fed has been really, pretty specific that they're not going to be cutting rates anytime this year. And the market seemed to, there was a period there where it was like, well, we're just going to, we don't believe you. And so it was just doing its own thing. The market gets very emotional. It's almost like a child. It just kind of has its own mind. We have a grandchild here that I see that she's 2.5, and it's amazing to watch what she says and does. So anyways, I kind of think, she reminds me of the market, what she does. So, but we're getting, so the market and the Fed, kind of were at odds. I think it's kind of starting to realize that maybe that's not what's going to happen. So that's a big problem. That may lead us to continue down and maybe even to new lows. Another concerning sign is that there was just already signs of speculative excess. The meme stocks were back in the news. SPACs were back. Retail investment, we talked about this a few days in the notes a few days ago. The retail investor is pouring in. Traditionally, Wall Street calls retail investing the dumb money, and they're the smart money. And that's true. There's a lot of times the retail investors come in at the wrong time. They come in when they start feeling that they're missing out, and they have FOMO, and they end up coming in at the tops, and the institutions sell it out to them. And that was really what happened again during the bear market with all the tech stocks. As interest rates were rising, the valuations started dropping, but the retail investor was just pouring into Tesla and all that, and they got their heads handed to them, because you can see the hallmarks of selling from institutions. When you see these giant spikes, I think it was Bill O'Neill of Investors Business Daily would say, that's not your Aunt Betty selling or buying when you see big blue spikes on the chart. That's the institutions that have billions and, well, these days you add it up and it's trillions of dollars of buying power. So, it's not Aunt Betty with her 100 shares getting in or out of. That's the big guys, moving the market. So seeing all that excess already coming in, and remember, the market had a follow-through day on January 6th, and we're not even 2 months out. So that's a warning there that already retail is just pouring back in. I have a feeling that's not going to work out well for a lot of those people. And then we have, really, this is just showing what's happened with interest rates. You can see this is the 1 year, basically down at zero. This was 0.0625 here. This is even lower, and we're at now over 5%. A market to just absorb this kind of a raise in rates and really not do much is really, I think, in a way, this is what's the market's a little bit in denial. That's what I sort of feel. That, there's been trillions and trillions, tens of trillions of dollars of borrowing, and it's still going on. You see, I read articles, money's just pouring in, tens of billions into various sectors that, remember, the money has to be paid back. It's not like the U.S. government can just borrow and have, trillions of dollars of debt and not really worry about it. So again, this is all going to reset. For people that borrowed money a year ago, or companies that borrowed money a year ago, a year later, they're going to have to renew or will pay back the old loans with 0% interest rates, and then now they're borrowing at much higher rates. That just has to have an effect on the market. So, but just coming back to this chart, you can just see here, interest rates are not turning over. That's what the market is counting on, and we're just heading higher. So this is really a problem for the markets. It was starting to price in, the Fed was going to cut, which would mean this would be coming down. Until this starts coming down, I don't think we're going to see a meaningful rally that's going to go far in this market. And finally, we've talked about this every week for quite a while. You got to respect the trend. We are still in an uptrend, though we're under pressure. And the market's telling us, hey, we're starting to have a little bit of selling going on here. It may not last. It's trying to, remember, the market's always trying to discount what's going on. It's already trying to discount all this. You can see here, this was 2022 as interest rates were rising and rising. Market just went to a bear market. And here, as the interest rates sort of leveled off, the market has been trying to rally because it was trying to figure that was the peak and it can only go down. But we're not seeing that. The market's just starting to keep going up a little bit, and we're starting to struggle. So while the indexes, if you're an index investor, they're still hanging in there, but we're starting to get little signs of cracks. So you don't want to get too bullish or too bearish because we don't know what's going to happen. If you're an individual stock investor, we're just seeing, I think, how this is playing out in stocks, and leading stocks are just not working. There's been too much volatility. Too many stocks have broken out and now coming back down, broken below. There's been some real high, big sell-offs. So we're just not getting, the market's not telling us, hey, it's time to pile in with all your money and this is easy and you're going to, make a fortune. It's actually starting to tell us the opposite, is that you should be very limited in what you're doing. And that's why when we come back to, let me go back to our original thing here, we just have 15% exposure because the market has not been giving us any sign that we should be going any more than that. Every time we've been moving up a little bit, we're getting stopped out. We got stopped out of all of our stocks. We had 3 or 4 positions, and we got stopped out of all of them within 10 days. And then we also see that a lot of stocks on our lists have just been falling off. So what is that telling us? That it's not the time to be getting heavily invested. If anything, we're going down to, I wouldn't be surprised to see this back at 0 if it really starts going back in earnest. So, but we keep an open mind. It's just, that's what we're getting. So that's what we are. We're just taking small positions in our stock picks. And if we got kicked out, we got kicked out, and we just continue. If it's not working with 1 or 2 positions, you just let those go. If they get stopped out, that's telling you something. If they're working, then you add exposure. The indexes too. We've sort of lost our buffer here for the NASDAQ. We're down to now. If we get any more sell signals, we actually start going down in exposure. S&P is really one more institutional selling day, and we're going to be racking up market count sell signals. We've dropped a little bit. So that's it. Overall, we got the caution marks. So keep an open mind. The market can go anywhere. In the short term, it can do anything. But just listen to the market. It always will tell you what's going to happen. And by listening, you can avoid a lot of the pain that other investors experience because they just go by emotions and FOMO and things like that, where they just feel like, oh, I'm missing out, and they pile in. And usually, unfortunately, that's at the wrong time. Okay, well, we'll be back next week with another video, and we'll see how the market does during the week. Okay, thank you.